You know, it went extremely well, kind of shocking. For the 21st 20-year auction brought back in May of 2020, the yield at the auction, 2.21%. Lower than the when issued yield, which means lower yield, higher price. I gave it an A as an apple. Demand was very good, but we all need to realize that 20-year bonds have the highest yield on the curve, higher than a 30-year bond. Why? Because of the liquidity factor. 30 years more liquid, and there's a premium associated with less liquid 20-year. Let's go through it. So $20 billion, the bid to cover, well, 2.48, so almost $2.50, chasing every dollar's worth of securities available. That's a solid number. 66.2% indirect is a very big number. It's the second largest in the 21 auctions of 20-year, and it's the best since July of 2020. And it represents foreign interest. Direct bidders was the only metric that was just a smidge light. Dealers take much less than the 20% 10 auction average at 16.8. Remember, you want dealers to take less. They're the people cleaning the top of the buffet after the investors are done eating their lunch, which in this case was 20-year bonds. And I find it very interesting that after the auction and right through it, yields are dropping. Right now, we're at the low yield, high price of the day. And contrary to the last guess, most of the bond traders and equity traders I talk to think that the Fed will always keep one eye on the equity markets because they've done an awful lot of work and expended an awful lot of their balance sheet to keep it buoyant.